Hello and welcome to Real Vision, the Defiant's weekly show, flogging the top stories into submission with wit, insight, and a frightening lack of respect. And in my case, at least one whole can of hairspray. It takes a lot of work to keep this barnet in check. And joining me for this flash bash of the cash crisis we call cash, it's Ash Bennington, while the other chair is poised precariously on its points, and the terrifying knowledge that the person perfectly perched upon it can only be Camila Russo. I am, of course, the Defiant's in-house wordsmith. This is the show. Ash, welcome back. It's been a while.
It's been a while, man. It's good to be back.
Cami, how are you?
I am good. Very happy to be here. A little bit sore because I started going to the gym. But other than that, ready to roll.
I thought you were going to say you've been to Bitcoin Miami and a bunch of other conferences, and it takes a toll on the physique.
Yeah,
it sure did.
That as well.
Are we seeing some spring and early summer joy in the markets? Ash, what are you noticing out there?
Yeah, exactly, Robin. Markets right now above some of the key price levels that we saw for support. Bitcoin right now trading at 41,572. Ethereum at 3,099. This is according to CoinMarketCap. These are obviously some critical levels that we see above the 40,000 level and above the 3,000 level, which have been breached a bit earlier.
Cami, are you seeing some optimism from the DeFi side of things?
Look, I think, yes, maybe we'll see a bit of relief from people being done selling their crypto to pay taxes. And I'm so glad that's over as well, ripping off the Band-Aid. But I think, this year comes with so many headwinds for crypto, and we've talked about this before. We are following a huge run-up, a huge bull market that was the past couple of years. There's this whole macro environment with interest rates rising, with a war happening in Ukraine. So I don't know, I'm not very optimistic that we'll everything will just magically go away and crypto will return to a bull market. I think we'll continue to see a lot of volatility.
Hey, can I pick up on that tax selling point? Because it's a really interesting one. There's a chart that I saw in a CoinDesk story. It's a joint NYDIG Bloomberg chart that shows the correlation between NASDAQ Composite Index and Bitcoin trading at 0.7. That's a correlation of about 70%. So what we're seeing right now, it seems, is this sort of traditional assetification, I don't know if that's a word, of what's happening in Bitcoin as people are making moves around tax season. So it's a really interesting thing that we're seeing. This is not something that historically has played a major role in markets when you go back several years. So this really does look as though we're starting to see Bitcoin and potentially other crypto assets come more into the traditional tax regime in terms of the way investors are beginning to hold those assets, Robin.
Do you think that's a reflection of who's holding Bitcoin and their natural seasonal habits as people that deal with money on a daily basis?
Yeah. Yeah, I think that's exactly right and very well said. It's about the broadening of the base of the asset class. If you'd gone back, say, 5 years, I don't think this was the case. We didn't see this type of pattern to quite the degree of correlation that we do now. But what we're seeing, exactly to your point, is this notion that Bitcoin is trading effectively like growth stocks. That shows something about who's buying it and the way they're thinking about those assets.
I was doing a piece this week on just getting started in crypto. And it feels like we should have done this piece like 4 years ago, but I was reminded of just what a journey it is, even just to get to a wallet. And then we start talking about volatility, and you start talking about the risks. This is a volatile market. And then I looked at the Tesla chart. I was like, it's every bit as volatile as the Bitcoin chart. It's just nobody thinks of it that way. It's this kind of blue chip. But I mean, volatility.
Well, I wouldn't say Tesla is a blue chip. Tesla is very much a growth stock and very much one that has a sort of a market darling effect because people are incredibly bullish about ultimately the outlook for where electric vehicles will go and the belief in Elon Musk's leadership. But it doesn't trade, for example, the way a boring Dow Jones Industrial Average stock would, that would be basically trading at a very sort of narrow, justifiable multiple based on earnings. So, to your point, I think you make a really good one, and it's an interesting analysis that you begin to see perhaps the extreme growthy end of the spectrum with tech stocks starting to look very similar to the way that digital assets are trading. But it's kind of a continuum, and I think that maybe in some ways that represents some aspect of what's happened when you have this massive glut of liquidity in markets from many years of coordinated central bank easing that's now beginning to come to an end. And that's also sort of a key inflection point that's going to be very interesting to watch, Robin.
You caught me out using the term blue chip, and you're absolutely right. I have become anesthetized to the sort of general misappropriation of terms in this market, particularly when it comes to NFTs. Like, people have been using the word, like the phrase blue chip, in relation to things like Bored Apes and punks and everything else. They're not at all what we would consider blue chips. They're just elevated price wise. And that's kind of it. But like, we use that term in DeFi as well, don't we, Cami? We talk about blue chip DeFi projects. Are we completely just off base here, or is it really we don't have the right terms to describe these earlier and more established projects?
No, I think we as in kind of, in DeFi, borrow terms from traditional finance, even though they don't perfectly fit in the same way. But everyone kind of has this general knowledge that a blue chip means a financial asset that has this kind of maturity, like longer standing reputation, that's been around for a while, and that's hard in a space that's only been around for 2 years or 3 years max, for DeFi. But blue chips in DeFi are things like Compound, like MakerDAO, like Aave, just like the very first protocols that started making up this space. And things like Yarn, like the first yield aggregator, and so on. And I remember there was a point where a lot of these like so-called blue chip DeFi tokens also had a blue logo. So that kind of like helped bring the meme to life. But yeah, no, I mean, it's kind of co-opting terms that we understand from TradFi, but don't necessarily fit in the same way.
Yeah, I think you guys both nailed it. That's what we do. We borrow terms in ways that try and make things analogous. But to your point, Robin, I think absolutely spot on. These things are incredibly relative. So I'm looking right now at the Investopedia definition of blue chip: established, stable, and well recognized. Now, on a relative basis, you could say Bored Apes are a blue chip NFT in the sense of relative to the rest of the asset class. But I think it's important for people to understand that these are obviously highly, highly speculative. It's worth thinking about a little bit the distinction between the way securities trade, for example, at least in theory, and the way digital assets trade. The most important point to make about NFTs is there are no cash flows. When you buy a bond, for example, you're making a bet on whether or not you believe the creditor is able to make timely payments on principal and interest. When you buy a stock, you're basically speculating on the relative multiple that it's trading above its cash flows, above its earnings. When you're buying an NFT, there's no fundamental basis to make that analysis. It's purely a speculative bet. Now, that's not to say that it's necessarily something that's going to go down, but people need to understand when they're buying into these tokens what they're getting and why they're doing it.
Or do they? The classic retail meme stonk investor doesn't care. They want the story. And that's where the NFTs are so powerful, but also so toxic in a sense, because they overvalue the story above everything else. I was reading an interesting article together the other day about these NFTs that supply their own native tokens through staking. So you lock up an NFT and you get these tokens dropped to you, and it becomes this sort of self-perpetuating pyramid scheme unless it's backed by something. And there is one project on Solana that has something to back it up, which is kind of sort of getting to where what your point is. There is a profitable activity which can be used to back up the value of the token that they're dropping to you. Otherwise, you're literally just expecting other people to buy an NFT, stake it. There's a cost to that NFT purchase, but you'll never make it up through staking because it's impossible. So you just need people to keep buying the NFT. And then you get into a problem, because if you lock the NFTs up, they're no longer on the market, so people can't buy them. And the whole thing becomes constipated. So inevitably, it diverges to zero. Fun stuff.
I think, the reason why we have this problem that NFTs that it's hard to back NFTs with actual flows is basically regulatory constraints, like the fear that if you do that, then the SEC is going to come down on you. Like, it's going to crack down on you. And so, I think that's a shame. I think if regulators were more open to, letting people do whatever they want with their money, and instead of, kind of constraining this industry, I think we'd have a lot more sustainable experiments and business models. I can kind of think of my own NFT project with the Infinite Machine. Ideally, I would love to give NFT holders a share of profits of the movie, of like royalties. I can't do that because, there's lawyers will tell us, no, that will be considered a security if you do that. So we have to do all these workarounds and try to offer some sort of value to NFT holders, but it's only because there's this fear of regulators cracking down, and it's an example of how flawed the regulatory framework has been in regards to crypto.
Well, you've teed me up for a beautiful segue here, because back in September last year, Coinbase launched a lend product, or at least they tried to, and then the SEC said, and they announced litigation straight away, and Coinbase went, what the hell? So Coinbase is very, very sensitive to what the SEC will or won't like, and Coinbase is about to launch its NFT marketplace. This story broke literally 45 minutes before we started this stream, so we're a bit fresh to it. But Ash, do you have a hot take on this one for us?
Well, let me also just play a little bit of devil's advocate to some of Cammy's points earlier. So I would say it isn't just the crypto space that the SEC is cracking down on specifically. These are laws that have been in place for many decades, indeed since the 1930s and 1940s. And the idea was that investors needed protection. And the reason that investors needed protection was because we saw all kinds of egregious types of fraud and fleecing of investors, and that's why you have these ideas that were put in place by those major acts in the 1940s and 1930s, and also the Howey test. This is this idea that if you have an investment of money in a common enterprise with the expectation of a profit that's to be derived from the profit of others, from the work of others, that effectively you have a security. So, I don't have the answers here, obviously, but there are sort of compelling arguments, I think, on both sides for how this space is going to be regulated and how it's going to ultimately shake out. So it is, I think, a pretty complicated topic, and one that is intriguing to watch, because you see the tensions that I think Cammy pointed to so elegantly, which is that there is this sort of desire to create. There's this desire to create, these novel applications to do cool things with this very interesting new technology, and yet at the same time, there is this fear around investor protections, around fraud, and how that gets shaken out is really going to be, I think, one of the most interesting and compelling aspects of this space. To your point about the NFT marketplace at Coinbase, I think on its face, what it tells you is all these topics that we're talking about right now are things that are becoming broadly interesting to a very wide range of people. There's a reason why Coinbase is launching this marketplace. It's because there's incredible interest from their customers and their potential customers in NFTs. And it's really, I think, going to be something that is a great test case for how this can work in a regulated environment. Coinbase, obviously a broker dealer that's fully regulated by a whole alphabet soup of agencies here in the United States. So it's going to be really interesting. And I think this sort of ties in nicely with what Cammy was pointing out, to see how this works in NFTs with a regulatory framework around it.
It really is. The numbers are staggering. I was just looking at how many customers Coinbase has. 89 million verified users. 89 million.
Yeah.
Great.
And they've all been AML KYC'd, right?
Yeah. It's a lot. It's really a lot. That's way more than I knew. And actually the 11,000 institutions and God knows how many ecosystem partners as well. It's significant, actually.
But my question there is, and I think the way that Coinbase is framing this NFT marketplace. I of course, like, I haven't used it, but I really like how they are building it, because, you know, one thing I liked is that it says that you can connect any self-custody wallet to this marketplace. So they're not creating this like walled garden around the Coinbase products. And it looks like it's not just for Coinbase clients. If you're able to just come with your MetaMask and trade and sell and buy and sell NFTs on this marketplace, so it's not necessarily the case that you'll have to, you know, go through KYC and have trust Coinbase with your funds to trade NFTs. If you can just plug in with self-custody wallet, I think that's a great way to build it. Very much kind of integrating with the rest of Web3. So I thought that was really, really good. And then the other aspect that's interesting is the social aspect, which this is, you know, what this space is all about, right? Community, and connecting with people and sharing and commenting. And it looks like that's going to be a big part of this platform. So I'm really interested to see. I think it looks like they have been kind of building, like they say, in the open. I don't know how open actually, but at least that they've been gathering a lot of feedback from the NFT community, and it's good that they listened to these requests, because I think that's kind of exactly what this space is about. So still kind of TBD how it all looks and works, but just by like reading this release, I'm pretty bullish on where this is going.
But isn't it interesting that those non-custodial wallets then are going to be tied to a U.S. person that's been AML KYC'd? In other words, you've gone through the AML KYC procedure. You've got their social security number. You've got all of their data. You've got their U.S. address for U.S. persons. And now you can tie the non-custodial wallets cryptographically based on the fact that you were able to sign that transaction to a U.S. individual. That has interesting tax implications.
Yes, it does. There's so many implications. Coinbase actually contacted me recently demanding a huge amount of data on me, which I was forced to give them because failure to comply would have resulted in the end of my Coinbase account, which I didn't really need at the time. But I can understand why this is happening. I just don't like it very much. But I have seen a screen grab of, I mean, someone who's actually one of the first 100 people who's in. And you're absolutely right, Cami. It looks very social, and the first thing that springs to mind is this is Instagram for NFTs. Now, whether you want that or not from a highly centralized platform like Coinbase or not, it's definitely a differentiated product from OpenSea, which hoovers up the vast majority of the revenue that comes from NFT sales at the moment. And I was looking at, you know, Bored Apes. There's just in the last 24 hours, they've done something like 5 million in sales. And you work out the royalties on that. That's just in the last 24 hours. They are making so much money. It's terrifying. And like Coinbase is going to generate so much revenue from this. I'm very curious to see what the listing fees are going to be. But definitely the social aspect to it is an add-on. It's a definite kind of community builder. And I remember when I first started using Instagram, I thought it was a set of filters that I could put on my photos. I never thought of it as a social media platform. But that's exactly its great power. And you can see that starting to form around NFTs. Of course, there's so many scams out there. What's going to be the blue check mark version of all these things? But yeah, it's a fascinating development. And you know, we talk about Bored Apes, ApeCoin, Bored Apes, the Otherverse. The whole ApeCoin has just gone bananas, if you excuse the pun. I mean, I had a chat with Raul about it, why he bought his ape. I know his thesis. From a distance, Ash, do you feel positively towards it, or are you a skeptic in this regard? I'm really curious what you think of the whole thing.
I'm absolutely fascinated by it. I mean, I think we're seeing, particularly in Bored Apes, we're seeing this ecosystem get born in a way that's starting to develop in, I think, really interesting ways in terms of the content that's being created around it, in terms of the ecosystem, in terms of the governance, in terms of the interactivity. So I think the art is really cool, and I find it absolutely intriguing. Now, with all of that said, I think it's really important that people who are listening to this understand the difference between, investing or buying a Bored Ape, perhaps might be the better term, and investing in, investment grade bonds. These are very different things, and I think it's really important that people understand that continuum of risk. Again, as we were saying earlier, not backed by any inherent cash flows, but it is absolutely fascinating. And I think that the people who are buying in right now, Bored Apes right now are trading at a floor of 120 Ethereum, which is about $360,000. So the folks who are going into the space obviously have a fair amount of cash to spare. Whether or not buying a $360,000 ape is something that is wise. Look, that's a question that the people who are buying it need to answer. I mean, we were talking a little bit, I think, offline about moonbirds, which is one of the hottest topics. I'm surprised it took us 30 minutes to get to moonbirds today. I think the art is really cool. It's really interesting. But again, right now, a floor price of 20 Ethereum, that's about 60 grand. Now, where you stand on investing $60,000 in a piece of art, that's something that's obviously a very individual decision. Look, I worked at a bank with a guy who bought a pair of speakers for about $60,000 and he loved them. I think he built a room around them, right? For him, it was, he was making obviously a lot of money. He was doing very well. And so it was something that was fun and interesting for him to do. And if you're thinking about NFTs in a similar vein, I think that that's, totally cool and that's your decision. But people really do need to understand, I think, something about their asset allocation and what they're investing in terms of its speculative nature.
I think you also need to understand who also bought them and when they bought them, because there's a whole bunch of dynamics going on here that define the nature and the hierarchies of the communities. And I'm fortunate that I've been at the early stages of these Discord channels for a lot of these projects. And it is interesting how you go through these phases. The whales come in and they become cartels, and then they wash out because they get bored and they move on to the next thing. And then you get this next wave of more sophisticated, more thoughtful, quote unquote, investors who decide that they want to add value in some way. And it could be, through creating networks like Gaio Series, the perfect example of this with the Bored Ape Yacht Club. He opens doors to celebrities and to other things that might happen, but that sheen of excitement and gloss that these celebrities added to the Bored Apes was completely unthinkable. So you have this club membership where you are in the same club as, all of these famous people, and you're like, wow, I am somebody. I'm somebody. And I think that's the whole allure of the Moonbirds. It's Kevin Rose. Whether or not you like Kevin Rose and whether you think he's worth being in a room with, Proof Collective, which is this collection of a limited number of membership tokens that are going for around 100 ETH, that put you in a Discord channel with Kevin Rose and a bunch of other people. I know people who are in there. They said it's basically a bunch of mumblecore enthusiasts kind of dribbling over their kids while they change their nappies or diapers. Sorry for the US audience. I was like, that doesn't seem to me worth 100 ETH, but of course I'm being cynical. But Cami, the membership thing is something obviously we have to think about because of the Defiant and what defines a membership. What do you think of the value proposition of something like Proof Collective?
I don't know. For me, it's hard to kind of put a price on it. Maybe, like for me personally, like it's not very attractive. Like I wouldn't pay that much just to be on a Discord with. Okay, so it's Kevin Rose, which is a well-known figure in the NFT world. He has a podcast, and there's like there's 1,000 members in this Proof Collective. There's other big names like People involved, Gary Vaynerchuk. Who else? Mike. Justin Metzel, who I don't know who he is, but so there's like this array of like NFT influencers, artists, who I think for some people it might be really alluring to be a part of the same club. Like I get the appeal. I don't know how sustainable that is. It's like to create this sort of community that can sustain this sort of price tag, which I think the price of like what's the price of the proof right now? It's like 98 Ether. Is
it's
that
been
right?
It's been around 100 ETH. Yeah,
100 ETH. So like $300,000 to be a part of a club. of famous people around NFTs. I don't know, that's a bit mind-blowing to me, but I still kind of understand why somebody would, if they have like all that cash, what would, you know, they want to be cool and be a part of this club, sure. But you know, this is what that is. It's belonging, it's community, it's being a part of something bigger than you, and those are themes that are, you know, have been around for as long as human beings have been around. That's what religion is, really. So, you know, it's another form of belonging and believing in something. And if you want to believe in these pixelated birds, then, you know, people should be, you know, happy and able to, I guess. It still kind of blows my mind. I really kind of don't really get just like these like incredibly high price tags. Yeah, it's just like blown off every record. Like in 2 days, they sold 200 million, over 200 million in Moonbirds. The volume is already topping Bored Apes. It's beating Azukis. It's beating, like, I was talking about blue chips, like all the NFT blue chips. These birds are beating, and it's not. I mean, the art is fine, but it's because this group of well-known people is behind it.
Well, it might be, or it might be something else entirely, which is just a very well-coordinated marketing campaign, because that's also
wash trading. Yeah, there were like accusations of that, of manipulation and wash trading. So that's true.
To give them their fair due, they launched another project called Grails, and they had 20 unknown artists, and amongst them were Tim Ferriss and Gary Vaynerchuk and Gremplin, Tyler Hobbs, probably the most well-known art blocks generative artist, Alexis Ohanian. I mean, like, they're connected. This is basically, you're buying a Rolodex here, or connection to a Rolodex. And yeah, it's not for me.
You know, Scott Fitzgerald wrote, "The test of a truly first-rate intelligence is the ability to hold two opposing views in the mind and still retain the ability to function." Look, here's where we are. On one hand, we are absolutely partying like it's 1999. I remember the dot-com bubble. I was one of the young guys in my 20s at that point. I remember the kind of euphoric, explosive price action that we saw back then. Fortunes were made. Fortunes were lost. There were enduring companies that were built like Amazon. There were companies like Pets.com that disappeared, never to be seen again. I think that's a very similar place to where we are today. The other side of that coin is that during that period, during the late 1990s, we saw the infrastructure of the internet built that has become absolutely integral to the lives of just about everyone today, not the sort of the narrow community that we see, for example, in the NFT space, to the point that both of you guys were making. I think we're seeing the development of these ecosystems that is going to be the way that communities, the way that people interact. There's just a tremendous amount of fascinating stuff that's being done here. But the price action, you know, it's like flip a coin, whether it's going to go up or down today or tomorrow. You know, you see these numbers, as Cami points to, these just incredible run-ups in the value of these NFTs that fundamentally aren't backed by any cash flows. And yet, you know, you could see a significant retrenchment. We've seen these downturns where there have been huge losses in tokens. We've seen this obviously in the NFT space. We've seen it clearly in the DeFi space. So buyer beware.
So that takes us neatly to our final story, where we are talking about a major loss in a DeFi governance exploit. This is Beanstalk Farms that lost $182 million in an exploit. And it wasn't even really what you could call an exploit. It was just taking advantage, which that is exploiting something. But essentially, Beanstalk Farms operates an algorithmic stablecoin, and they're very proud of the way they do it, using a credit-based system. To be honest with you, I didn't really understand it. It's so full of farming metaphors. I kind of got lost in the weeds. Ha ha! But they have a governance system. They have a governance token, and an attacker was able to take over the governance by basically taking out a flash loan and then grabbing 67% of the vote and ushering through a proposition that would allow them to drain everything in the account. So this is a stable coin that's supposed to be pegged to the US dollar. As I look at it now, it is worth cents. And for the first time in my life, I see a total value locked on the platform of negative $258,000. I've never seen that before. This is a catastrophe, an absolute disaster. So, I mean, I guess the main talking point is like, this wasn't a VC-backed DeFi protocol. They literally said, we are fucked because there's nothing they can do about it. There was a vulnerability, someone exploited it, and they're done. And this is supposed to be a stable coin. Yeah, it's pretty bad. And the numbers are massive as well. This wasn't just a kind of mini thing. This is a significant amount of capital people have put into this thing. I guess, Cami, like algorithmic stablecoins they're a lot of fun. They're so sketchy as well. They really are.
Yeah, I mean, I think like the interesting points here are obviously kind of the risk of very early DeFi protocols. This one had just been launched. Whenever there's a project without that much history and with a lot of assets at stake, there will be a big incentive for hackers to come in and figure out how to exploit it. So anyone using a very kind of recently launched DeFi project should be very, very careful. And the other interesting point here is around governance mechanisms. So this hacker was able to use this amazing innovation in DeFi, which are flash loans, that how these works. You're able to borrow as much as you want, as long as you return that amount in the same block. So this tool has been really frequently used by hackers because it doesn't require any capital. That's the thing. Like, you don't need collateral. You don't need to put up any collateral to take out these loans. So if you have all this capital on hand, and these protocols have governance that's tied to tokens, to amounts held in tokens, then these governance systems can open up these kinds of exploits and risks. So there was a lot of debate that emerged from this hack around governance and whether these protocols should even have it. I think I saw Vitalik tweeting that maybe they shouldn't, that they should just be made to run, and maybe there can be governance for very kind of marginal decisions that wouldn't affect kind of the money side of how the protocol works, to minimize this kind of risk. So I think obviously this is one of the biggest problems in DeFi. Token governance is far from perfect. I think it creates risk. It creates oligopolies in the way that it's structured. Basically, whoever owns the most tokens has the most power and is able to change the protocol in whatever way they want, including draining it in the way that it happened in this case. So, I mean, I guess main point is be very careful with recently launched DeFi projects, and it's something to kind of take into account when thinking about how governance should be designed in DeFi.
Yes. I mean, if something is to be decentralized, it kind of has to be organized around a decentralized voting process. But this was a real cock up.
I mean, this is a show entirely of its own. I was reading the story on CoinDesk. It seems that the person who executed the exploit, the person or people who executed the exploit, took out a flash loan on Aave, which they then used to purchase the governance token and then to drain the funds. This is kind of like, we were talking about this off camera, saying that this isn't a code exploit per se. That's a little bit like saying sort of the operation was a success, but the patient died anyway. This is an incredibly sort of murky area. If you don't have governance tokens, is the protocol truly decentralized on the one hand, and on the other, if being able to take a loan, a flash loan in another DeFi protocol, purchase the governance tokens, and then drain effectively the treasury of a stable coin is something that can be executed through the decentralized governance token. Is that something that you can countenance in a way that allows this to exist? These are existential questions, I think, about the way that DeFi is going to work. But by the way, another big question that we didn't talk about going into this is this idea of what an algorithmic stablecoin is. I mean, I think it's almost a definition by exclusion, for me at least. An algorithmic stablecoin is a stablecoin that doesn't hold assets in collateral that represent the value of the token, but rather have some sort of algorithmic mechanism. And I think it's probably important for people to understand why this is something that folks are trying to do. The idea here is basically that if you can have true algorithmic stablecoins, you're able to effectively decouple from the traditional dollar-based fiat banking and financial system. This is obviously a goal that many folks in the DeFi ecosystem, in the crypto space, are eager to pursue. I actually went up to the Medium page for Beanstalk and read this. This is their description of, and they don't actually use the phrase algorithmic stablecoin, which is interesting, but they say, quote, "Beanstalk does not have any collateral requirements. Beanstalk uses credit instead of collateral to create price stability relative to non-native assets." What does that mean? Does anyone know what that means? I don't know what that means.
I looked for about half an hour and I read it through and I watched the videos and I still didn't see anything that would ever make me want to part with hard capital. Yeah, the algorithmic stablecoin is basically, it's an algorithm that determines the supply. So you have these elastic supplies which contract and expand according to demand. And some of them are very successable and very resilient, like UST and Luna. And the
idea is that the supply elasticity then keeps the stable coin within a stable trading band. But this is something that is highly theoretical, and it's actually really interesting because it almost seems like we're having this convergence of this being picked up in mainstream financial media. Bloomberg did a very long, detailed piece about Terra and Do Kwon, I think on Monday. The Wall Street Journal has a piece out about algorithmic stablecoins right now. So these questions about how these things function, and as you point out, you can make it sound very elegant and mathematical. Well, the supply is elastic, right? But fundamentally, the question is there demand for the digital assets that are going to be created and destroyed, or going to be held relative to the assets that are created and destroyed? These are totally open questions. And the real answer to this is, I was joking offline, NBRFK. Nobody really fucking knows how this stuff is going to work. And nobody wants to sound stupid and say, I read the white paper and I don't understand it, right? But that's where we are. And that's what makes this an incredibly exciting space, an incredibly interesting space, but also the flip side, obviously, tremendous risk, tremendous instability. And when you see $182 million getting drained in one of these hacks, it really does make you think about it, and it brings it home in a very concrete way.
But I don't know if in this case the exploit or hack or failing of Beanstalk was because of its algorithm. Like, it's not because it was like an algorithmic stablecoin that this thing happened. I think the exploit here, like the risk, was the governance mechanism. But of course, like the fact that it is an algorithmic stablecoin just like added risk to this protocol, because these things are pretty untested. Like, there hasn't been, they haven't been around for that long. There's not like a history of stress that they have weathered well. Terra did, did have this kind of I don't know, this test, I guess, at some point last year, where it did decouple and then came back.
Well, it depegged. It depegged.
And
it was because there was a catastrophic loss of value in Luna, which was just correlated to the rest of the market. But it recovered.
Exactly. So
it recovered because
that's kind
the
of
rest
the
of the
big
market.
Question. Yeah. So that's, I think, like, Ash, you pointed to it. And that's exactly right. It's like the big question for these algorithmic stablecoins is, can they withstand a big crash or a prolonged bear market? And since they have just started to emerge in this last bull run, we haven't seen that yet. So yeah, but in the case of Beanstalk, I don't know if they'll recover, and I don't know if we'll be able to test that out.
Well, for me, there's only one test of a stablecoin. Is it stable? Beanstalk is now trading at 3
Right.
cents. So no. Therefore, don't touch it.
Maybe,
It failed.
Yeah.
It's as simple as that. And it doesn't matter what test you throw at it. It failed on the governance side of things, but it's still
Yeah.
depegged. Therefore, experiment failed. Game over. The end. I love algorithmic stablecoins. My favorite is called Gyroscope. Go check it out. It'll blow your mind. And thankfully, it's very small. It's very small. But yeah, that's a really fascinating one. Sorry, I jumped in on you, Ash.
No, I was just gonna say I think experiment is exactly the right word, right? That these are folks who are wearing white lab coats, and you've got a bunch of test tubes on the table, and it's really cool because this is how the frontier of knowledge gets expanded, is by doing these experiments and by hashing through these and by seeing where the flaws are and where the catastrophic failures are, quite frankly. But again, not financial advice, but I certainly wouldn't be betting the farm on this, right? And that's the risk, is that individual retail investors are out there and they see a track record of something, that's like 12 or 24 months, and they get really excited about it, and they're generating 15 or 20% yield, which is obviously something that's far beyond what you can earn in a bank account now by orders of magnitude. And the risk is that people are going to get hurt. And this is this tension that Cami was alluding to earlier, and that we've been talking about throughout the show, between the sort of the feeling amongst people, particularly in the regulatory space, that investors need protection, and on the other side of the coin, this idea that we're watching the future get developed here. Nobody has a crystal ball, but I suspect if we were to come back here in 2032, we would see a great deal more of this. This is an innovation that is truly, I think, one of the most fascinating things that we've seen since the creation of the internet. The idea that trust can be distributed in a network without a centralized party being in control. This is really novel stuff. It's really fascinating stuff. But occasionally, as we just saw, the test tubes blow up, and sometimes the laboratory catches on fire.
Over to you, Cami. How do you follow that? Ash was on fire.
Yeah, no, totally agree. I think a few things, and I'm gonna go with a couple of cliches. I think, first, you can't make an omelet without breaking eggs. So these exploits, these failings, these crashes, they're the price to pay for remaking finance. I mean, what more could you expect? So I think this is all worth it, to be honest. We are witnessing something revolutionary, and remaking kind of the rails of the internet itself and of finance. So things are going to break in the process. The other cliche I was thinking about is there's no free lunch, high risk, high reward. That's what's going on with DeFi. So yeah, if you're seeing 20% yield, there's probably a lot of risk involved there. But I believe that people should be able to do what they want with their money, and that if you have all the resources you need are in front of you, you have access to the internet. There is many ways where you can do your own research, and if you decide to put your money in Beanstalk Farms, then that's your decision, and people should take responsibility. I do not believe that there should be a third party telling people what they can and can't do, and I think that's the beauty of this space, that anyone can access it, and it's all open and permissionless, and you can participate in these wonderful monetary experiments, whether you're here in Brooklyn or whether you're my mom in Chile, and I think that's beautiful.
Well, Cami said it so well right there. There's very little to add to that, except sometimes the cliches are cliches because they touch on some underlying truth, and that's why we have these conversations, right? We're out on the frontier trying to figure out what's happening right now. We can see that the ball is in motion. We just don't know exactly where it's going to land, and these conversations are a way of just trying to frame that, trying to understand it, trying to figure out a way of making sense of these evolving paradigms that are just shifting so incredibly fast.
Yes, well said. I find it fascinating. I was trying to reflect on my NFT journey because I kind of went berserk last year, and seeing Bored Apes now where they are and trying to wrap my head around just how much has happened. Because there's this weird idea that the Bored Ape ecosystem is basically the Ethereum of NFTs, and that we're witnessing the birth of something genuinely significant with a great deal more room to grow. And that thesis could be heavily tested in the coming years, but I'm genuinely excited and horrified by it in equal measure. But two people I'm not horrified by at all, Ash Bennington and Camila Russo, thank you so much for joining us. We promise not to depeg the Real Vision versus the Defiant. And the only floor we will be dropping onto will be the 8th floor as we watch it in horror rise inexorably towards God knows what number. Thanks so much for joining us. We will see you next week for more of the same.